Welcome, everybody. This is Axel. I'm the President and Chief Investment Officer of Merk Investments. I'm going through this edition of our U.S. equity market chart book. These chart books are created by Nick Rees, our Senior Financial Analyst. He creates these charts, and while you absorb here the first chart, let me remind you of the background here. It's a chart set that he's choosing. He is trying to be as consistent as possible in what he shows and gives an as factual analysis as possible. The blue analysis you see below is his analysis. And the reason I mention this as a background is that my role is more to interpret the data. So I read more in between the data. He just presents the data as is. For this edition, I'm the only one who's giving a video analysis. Usually Nick gives a video analysis as well. So please do download the PDF and read the analysis that he has provided. He usually gives a little bit different flavor from what I'm providing. Also, very important this time around, in addition to this regular chart book, we do have a premium chart book. And these premium charts, I do believe, are quite relevant in the context of the equity markets for this time around. So if you have not subscribed to the premium chart book, there's an excellent opportunity. By the way, that there's no charge until the end of the month. So if you become a premium subscriber now and you absolutely hate it, you can cancel your subscription. You're not going to pay any money. So it's and the few bucks that we are asking for the premium charts, I think is money well spent. But aside from this pitch, I think there's a real meaning in those charts. And part of the reason I'm explaining to you that I'm reading in between the lines is, and that Nick is preparing these charts, that I might be more tempted to use a whole bunch of other charts in addition that we don't necessarily show here. Nick's focus is historically to focus on a consistent chart set. And the reason for that is that you don't want to be drawn too much to the news of the day or the tweet of the day. And by looking at a fairly consistent chart set that has many advantages, it does have some disadvantages as well, but it's an approach that I highly respect and appreciate. Now, the first chart here is a long-term chart of the S&P and pretty much an autocorrelation chart of how the balance of equities versus fixed income is changing over time. And some purists question the predictive power of this. Basically what this shows is that historically speaking, if the S&P has had a good run, then over the next 10 years, the returns in the equity market tend to be all mediocre, and we are currently at a stage where, based on that theory, the return over the next 10 years should be near zero. Mind you, this is without dividends, but still, it's no secret that we're in a very advanced stages of a bull market, and if one wants to have a reason to kind of take some chips off the table, this may be as good an excuse as any. One background here and one thing that I like to emphasize is when I manage money, when I look at a portfolio, obviously one of the reasons we look at this chart book is to see, hey, is this bull market going to continue? But if you look at it from an investor's point of view and do a gut check either on yourself or an investment professional on your clients' behavior, one of the things I have historically said is that if you have more money invested in the markets than you're comfortable with sleeping at night, then you're overexposed to risk assets. So if you take a step back, go to kind of the drawing board, you ask, hey, what's your risk tolerance? And you spit out a number, you don't really know what it means. And then you work with this number. Well, first of all, it's good to revisit that sometimes. But importantly, think about you invested in a balanced portfolio, whatever that may mean for you, in spring of 2009. Well, odds are that portfolio is no longer as balanced as it was because the equity portion has done tremendously well. And one of the reasons you might have been comfortable with that allocation, even though the equity portion is getting bigger and bigger, is because it's been going so well. And also partially, and I at least say so, because of quantitative easing, volatility has been compressed. So you haven't really noticed that risk portion in your portfolio has increased. And guess what? Just a little while ago, we had volatility sometimes spike up a little bit. And then you suddenly realize, oh my God, the stuff I hold is risky. And guess what? It is riskier than what I signed up for. Back in 2009, or whenever I came up with my financial plan, I decided this is the sort of risk tolerance I have. And now what, right? And so the reason I say this in this context is that the rebalancing one is often encouraged to do. You can do that on say a 60-40 allocation where you have equity versus fixed income, but you can also do it on a risk tolerance basis and saying, hey, I'm only comfortable with those sort of risks. Now, in that context, of course, there are some specific investment strategies to do that. The risk parity strategies that say, hey, I'm allowed to have a certain amount of risk in the equity market and a amount of risk in the fixed income market. Mind you, those strategies were hit particularly badly in the recent sell-off we had in the equity markets, because both stocks and bonds sold off in that environment. And those risk parity strategies, by the way, tend to have substantial leverage on the fixed income side, because you want to have a quote-unquote equal amount of risks, and then when the volatility spikes in the equity market, you have to scramble to adjust it, to take it down and whatnot, exacerbating sometimes these sell-offs. So I'm giving you a little bit of flavor for the kind of the human element of all this. I'm not suggesting you should follow a risk parity strategy or this or that strategy, but whatever your strategy you have, you want to have a gut check once in a while, and that gut check means also to rebalance to what you wanted to do at some point, right? And it is when you have these years and years and years when the markets are doing well, we tend to forget some of these things. And as you may be well aware, at Merk, we do a lot of work on trying to generate uncorrelated returns, and it is precisely because of the sort of thing you saw in the markets where both stocks and bonds sold off simultaneously. You want to have more in your in your kind of toolbox to choose from. Bernanke used to talk about this toolbox, and so investors might as well have the same. So let's go into these charts here a little bit. Earnings backdrop still looks dandy. Everything looks fine. Earnings momentum is going to slow down a little bit, obviously driven by the tax cuts as well. And so from that point of view, things look good. Business cycle also looks good. And so we have on the global side some cautionary tales. And if you go around the world, the green one here, for example, is Germany. The PMI has trended down. Oh, mind you, 50 is considered the break even, I say. When it's above 50, we talk about economic expansion, or the PMI is trying to suggest economic expansion, but they have come down. And some of it is perception, but a lot of that is also a real slowdown. A Chinese slowdown seems to be quite modest given the heating up that we see there. But that said, and by the way, the black line here is the S&P 500. That's not a PMI. But the question is this the end of the economic expansion? Or is this just one data point that suggests, hey, things are running a little late in the cycle, or there's a mid-cycle slowdown? Mid-cycle might be an odd statement given we've had that many years of expansion. The way I see it is that, again, I mentioned before, hey, you have this volatility go up, you might want to do a gut check. Well, similarly, what's the stage if we say, based on our analysis, all right, now we think the market is going to go down? Well, is that the point you turn a switch, or do you gradually rebalance? And it depends on the person, right? So, for example, this volatility flare-up of late might suggest, hey, wait a second, I don't want to have this, right? And then you look at where we are. We've had 9 years of bull market. It is perfectly okay to take some chips off the table, because while we might be very convinced to know when we're going to see the quote unquote turn in the equity market, well, that's just one of the many crystal balls out there, right? And you've got to take it into account that anybody can be wrong, and that includes us, of course. Financial conditions. Hey, financial conditions are still easy peasy, if I may say so. And that's very important, because the Federal Reserve has been hiking rates. In our Fed chart book and otherwise, I often say that the very point of hiking rates is to tighten financial conditions. This hasn't happened yet. And we've had a little bit of a kind of a blip there, but a tiny, tiny bit. And when people say that the Fed is going to come to the rescue of the stock market if the stock market were to plunge, they have 2008 in mind, where a plunge in the market coincided with a plunge in, with a kind of a tightening in financial conditions. And financial conditions have been doing just fine. And I would allege that a Powell Fed is going to shrug off a decline in the S&P 500 if it is not accompanied, I'm not talking about cause and effect here, but at least accompanied by a deterioration of financial conditions. And financial condition indices, this is the Chicago Fed one. I prefer this one over many other of the other indices because it refers more to the axis of credit. The other day I was a guest with Tom Keene on Bloomberg Radio, and I badmouthed the Bloomberg financial conditions index, and he was first taken aback. But the challenge of the Bloomberg index is that it is very much focused on volatility. And the mere fact that volatility in the equity market goes up doesn't really tell you much about more broad financial conditions the way I would like to define them, in the sense that it has meaning for what the Fed might do and access to credit in the economy. It might have a lot to say about how you feel about the equity portfolio, but to me, the information content of that is more limited. This is a unique chart here on market breadth that Nick has created. Basically, it shows the market breadth at new bull time highs. That's why it says on the chart it goes only to September 20th, because that's the most recent time we had a high in the markets. And then as you see that past these highs, we tend to kind of drift off, because as these bull markets age, we tend to the breadth tends to deteriorate. That's merely a numbers game in some ways. And there the warning sign kind of here is, hey, if we drop below that black line thereabouts, then maybe the breadth is actually truly sufficiently weak to signal a bear market. And by the way, just on the recent volatility we had in the markets, while it was very painful for the folks in the equity markets, and it was bonds dipped a little bit, and folks investing in gold noticed that the gold prices or gold mining stocks might have gone up. We did not see a broadening of that sell-off. It was very much a technically driven one, and we'll see a chart here in a moment. And we look a lot in the currency space and beyond, and we look at, is there stress in the system, and we didn't see that. Market sentiment, mid-range, nothing particularly exciting here to say about. Margin debt, there are different ways of looking at margin debt, but as a level of total debt, nothing extreme the way that Nick defines it here. And then there are two charts here with a long explanation, and you really need to sit down and look at the following chart in a little bit, maybe offline even. The gist of it, and I'm not going to reread here everything that's down there, is that when you have a high-risk portfolio, as in the upper right-hand corner, when volatility is high and correlation is high, the panicked environment, well, that's a counter-cyclical cycle, so to speak, that times may get better. Whereas if you're in an environment where everything is perfect, in the Goldilocks environment, low volatility, great dispersion of risk, well, then you may want to be concerned. And so this attempts to capture that, and you might want to read carefully on how these indices are constructed. But this black line is a rolling correlation of different S&P sectors. And so when the correlation is low, that's kind of the quote-unquote complacent area. The high area is more the panicked environment. And low correlation means that, yeah, things look great right now, but be careful. This is a cautionary sign. And then this is a particular way of measuring volatility, and I'm not going to get into details how that's defined. Let me just say here that, again, based on this particular metric, volatility is reasonably low, even though it has uptick. And so from that point of view, yes, the complacency is more towards the higher end, not extremes. We've have more extremes in some of that. But from this point of view, it means that, yep, be careful out there. Things are pretty good right now. Economic uncertainty index. If you believe in the story that there's a wall of worries to climb, then there is a little bit left to climb. I don't like this particular index too much, so I'll just skip over it. The VIX curve. Many of you learned about VIX and VIX curve earlier this year when we had the blow up in the VIX shorting game, selling volatility. Let me, without getting too complicated, you can trade volatility in the derivative markets as well, and it's very heavily traded. And so it's, by the way, one of the reasons why when you see the volatility metrics, you might want to take it with a grain of caution, because it is itself being quote-unquote manipulated because it's being traded. But the short of it is that usually the volatility is, usually in a quote-unquote normal environment, volatility is low with the expectation of volatility being higher, whereas currently you have it the other way around. You have elevated volatility with the expectation of future volatility being lower. And so that's why these gray bars are negative. That's usually a sign of you might have a short-term bottom, but of course, hey, these bottoms can become bigger bottoms. This is what I refer to here on the technical side. The S&P 500 has broken through its 200-day moving average. Nick writes here you'd get more negative if the 50-day moving average would be crossing below the 200-day moving average. Everybody has their own little favorite thing on this one. I do think it is noteworthy that we went through the 200-day moving average. But as I said, it didn't really spread to other markets. And so my conclusion from that is that if you are looking for ways to gradually take down your exposure as we're ending the end of this bull market, we've had as good an excuse as any with the breaking of the 200-day moving average and the uptick in volatility. If, however, you are more of the mindset that, hey, I need to have a long checklist, and let me give you here this checklist here, one of the ones we're using, where we want as many of these as possible to be neutral to negative, then yeah, we still have earnings going for us and a few other things going for us, that the economy is doing fine and so forth. And so from that point of view, we're not yet at the end of the bull market necessarily. Just going back to this chart since I skipped it, just a reminder, the returns each calendar year are quite volatile. It's rarely what people predict at the beginning of the year. You can read the small print there offline. And then here is Nick's summary. Again, download the PDF if you want to get more details. The one thing is also, you may want to look that into the context of other parameters of all of this. So this one's squarely focused on the equity markets. We have a chart book on the Federal Reserve, for example. I think it's very important, if you want to have me expand a little bit on the financial conditions. I mentioned that in my take there, for example. And then so we have several others that might be worth reading. And then just as you look at the disclosure, which I, of course, want to and need to show you, again, this time around, the premium charts, I think, are well worth looking at. They're always worth looking at. But especially since we have had these significant moves in the equity markets, the charts that Nick created there, and they are not always the same. There he does pull in some new charts to keep it interesting, and his explanations are well worth reading. And so with that said, give us feedback on these chart books, how you like this format, and subscribe to these, share them with your friends on the link to our webpage. And then of course, yes, if you are so inclined, please have a look at our premium charts as well. Thank you and have a great day.